Welcome to the deep dive. It's often, well, surprising to find exceptional returns in unexpected places. Have you ever considered how a company operating in seemingly traditional industrial sectors like storage tanks and boilers could deliver consistently strong shareholder returns year after year?
That's a great question. It really makes you challenge where, enduring value is actually created. Often it's not in the flashy headlines, is it? It's in the foundational, critical, and sometimes, yeah, less glamorous parts of the economy.
Absolutely. And today, that's exactly where we're headed. We're taking a deep dive into TerraVest, that's ticker TVK.TO on the Toronto Stock Exchange, market cap around a billion Canadian dollars. And get this, it's delivered approximately 30% per annum shareholder returns for the last decade.
Incredible, right? And despite that track record, it still seems to have significant potential for double-digit earnings growth going forward.
So our mission in this deep dive is to really get under the hood of this, well, under-the-radar company. We'll explore its unique roll-up strategy and the specific ways it extracts, frankly, astonishing value from these seemingly ordinary businesses.
That's the plan. We want to uncover the surprising facts, the crucial insights that make TerraVest such an exceptional compounder, and hopefully help you understand how an opportunity like this even exists and maybe what principles you could apply elsewhere.
All right, let's unpack it. Where do we start? What does TerraVest actually do?
Okay, so basically their core business revolves around acquiring, then restructuring, and finally operating businesses. These businesses are mostly involved with things like storage tanks, pressure vessels, cast iron boilers, furnaces, and also some oil and gas equipment. It's fundamentally industrial stuff, essential infrastructure, really.
Yeah, definitely not your typical Silicon Valley tech story. But you mentioned their roll-up strategy. Can you unpack that? How does that work, especially when buying these smaller, maybe family-owned businesses?
Right. So they typically acquire what people often call mom and pops or, privately held, often family-run businesses. They usually buy them at valuations around, say, 11 times net profit. Think of it as a simple earnings multiple.
Okay, 11 times seems reasonable.
Yeah, but here's the key. Through their operational restructuring, their improvements, they can pretty quickly bring that effective multiple down to about 7 times net profit.
Wow, from 11 down to 7.
Exactly. And that gap, that difference, that's where management creates a huge chunk of the value.
And what's really fascinating here, like you said, is why this company is still so undiscovered, despite that amazing track record. 30% a year.
It's a mix of things, really. First, TerraVest doesn't hold quarterly calls.
No earnings calls.
Nope, no investor presentations either. Their focus is just execution, running the businesses.
Okay.
Combine that with the, let's face it, unexciting industrial sectors they're in, plus maybe an initial glance suggests some fossil fuel exposure. Well, it's easy to see why the big institutional investors mostly just skip over them.
Right. It really does require some digging, doesn't it? First look, you might just dismiss it. Boilers, tanks, pass.
Yeah.
But when you actually do the work, you see it has these infrastructure-type characteristics, much more stable than pure energy plays.
Exactly. It suggests their lack of proactive investor relations isn't a bug. It might actually be a feature.
Yeah.
It keeps competition away, maybe.
Interesting point. So this brings us to how they actually get these businesses. How do they consistently buy them at what seem like good prices?
Yeah, it points to a kind of unique acquisition advantage they have. TerraVest often finds itself acquiring from what you might call less economic sellers.
Less economic sellers. What do you mean by that?
Well, think about owners who aren't necessarily laser-focused on squeezing out every last dollar. Maybe it's founders looking to retire smoothly, wanting to protect their legacy. Or sometimes it's even like real estate companies that ended up owning an industrial operation they just don't want. These aren't usually super competitive auctions with private equity giants bidding things up.
Okay, so they're often not fighting tooth and nail in big auctions, at least for the smaller deals. That makes sense. But once they do acquire a business, what's the secret sauce? How do they create that value? You mentioned looking at a specific example, like a big 60,000-gallon propane tank.
Yeah.
How do they take a business selling that for, say, 350 grand and make it way more profitable?
Right. This is where it gets really interesting. Let's take that 60,000-gallon propane tank, huge industrial thing, right? Not for your backyard BBQ. A typical small operator might sell it for, let's say, $350,000 Canadian. TerraVest can often charge a premium on top of that, maybe another $17,000.
A premium? Why, how?
Speed of delivery.
Speed of delivery.
Yeah.
For a giant metal tank. That seems counterintuitive.
It's actually a critical differentiator in this space. See, for many smaller operations, when they get an order, then they have to go buy the steel. That can mean weeks, maybe even over 10 weeks of waiting, depending on the steel market.
Ah,
Now, if you're, say, an oil and gas customer and you need that tank to start drilling or connect a well, those weeks matter a lot. You could be losing potentially millions in delayed production.
right. Okay, I see. The opportunity cost is huge.
Exactly. TerraVest, because of its scale, can afford to invest in large steel inventories. They have the steel ready, so they can deliver much, much quicker.
So if I'm that oil producer staring down a multi-million-dollar delay, yeah, I'd happily pay an extra 17 grand to get that tank now instead of in 2 or 3 months.
But why can't the smaller guys just keep more steel on hand? What's stopping them?
It's a fair question, but think about the numbers. A single one of these big tanks needs maybe $150,000 worth of steel.
Okay.
Now, imagine an order for, say, 10 tanks. Suddenly you're talking about a multi-million-dollar steel investment just sitting there. For a small family business, that's a massive capital outlay. It's a huge cash flow risk if those orders slow down. They just can't tie up that much capital. Got it. The scale is prohibitive for them. Okay, so price premium from speed. What else is in the secret sauce?
Oh.
You also mentioned significant steel cost reductions. How do they slice $20,000 of $150,000 steel cost? That's like, what, 10–30%? Steel's a commodity, isn't it?
It is, but how you buy it matters. This is where TerraVest's scale really kicks in again. Smaller businesses usually buy their steel from distributors. That adds a layer, a margin.
Right, the middleman.
Exactly. TerraVest, because it buys so much volume, goes direct to the steel mills. They cut out that distributor margin immediately. Plus, they negotiate bulk discounts that the little guys just can't access. It's a massive advantage. Honestly, when you talk to founders who sold to TerraVest, they often say this direct steel buying was the biggest single improvement TerraVest brought. It helps their old business compete better.
Huh. So it's not just about squeezing costs out. It's about fundamentally making the acquired business stronger through scale. That's actually a really positive synergy. It's not just cost cutting, it's building a better competitor.
Yeah.
Okay, what about labor costs? Your analysis suggests they shave off maybe $10,000 per tank there too. How is that just layoffs?
Not necessarily layoffs, no. This really comes down to TerraVest's operating skill. They aren't just finance guys. They know how to run these plants. First, remember their decentralized model. After the initial changes, they mostly let the local management teams run their own show, but they share resources effectively. If a small company had, say, 3 half-empty factories, TerraVest might consolidate them into 1 or 2, or merge operations with another nearby acquisition. That massively improves utilization.
Right. Efficiency through consolidation and smarter asset use, not just cutting heads.
Exactly. And second, they invest. They make significant investments in production equipment. A smaller private business often can't afford big automation projects. TerraVest can and does. I know of one case where they actually doubled the size of an acquired factory and put in a lot of automation. Output per worker went way up. These are strategic capital investments.
And I guess they get similar buying power benefits on other things too, like valves, parts, other raw materials, not just steel.
Oh, absolutely. Same principle applies. Bulk buying, direct sourcing where possible, it all adds up.
And maybe there's a mindset shift too, going from a family legacy focus to pure profitability.
Definitely. Many of these family businesses were run, maybe to provide stable jobs or keep a tradition alive, not always to maximize every single dollar. TerraVest brings a really sharp focus on profitability, line by line. They'll change incentive structures, maybe pay salespeople based on the profit of a sale, not just the total revenue. These might seem like small tweaks, but they drive behavior and add up significantly.
Okay, so that tank example is fantastic. It really shows the playbook. But what about the boiler business? You suggested the margin improvement there is more like 20%. Still good, obviously, but not quite as dramatic as the tanks. Why isn't the secret sauce quite as potent there?
Yeah, it's a bit different. The main reason is that steel isn't the dominant cost component for boilers in the same way it is for those massive tanks. So that direct from the mill steel procurement leverage, it's just not as impactful.
Okay, less commodity leverage.
Right. And one of their key suppliers for cast iron parts, a big foundry called Wild Poka, mostly serves the auto industry. TerraVest is a pretty small customer for them, relatively speaking.
So less bargaining power there.
Exactly. Also, boiler parts aren't as standardized across all the different brands TerraVest owns compared to, say, a simple steel tank. Makes bulk buying a little more complex.
Makes sense. But I assume the other parts of the playbook still work. Sharing resources, merging facilities where it makes sense, that profit focus.
Oh, yes, absolutely. Those operational improvements, the shift to a profit-centric culture, that all still applies and definitely adds value. And actually, this ability to apply their model, maybe slightly adapted to different but related industries, is really key to their future potential. Like, they recently bought Highland Tanks. That got them into the water storage market in a big way.
Ah, adjacent markets.
Yeah, and they're apparently seeing similar kinds of synergies there too. It shows there's still a pretty long runway for them in related areas. Think ammonia storage, maybe even heating oil storage, which they already do some of.
That's a great point. It really speaks to that entrepreneurial spirit you mentioned, finding new angles. Now let's tackle the maybe the less exciting part. Organic growth. These aren't exactly booming industries, are they?
No, that's fair. Organic growth for the core business is pretty low, maybe around 2%, something like that. And yeah, some of their older segments, like the traditional oil and gas equipment side or heating oil tanks, those are probably in long-term decline.
So if organic growth is that low, how does demand keep going? Is it mostly just replacing old stuff when it wears out or breaks?
Largely, yes, it's replacement driven, but there are some interesting nuances. Take propane tanks. They last a really long time, sure, but regulations change. For instance, rules might allow for larger, more efficient tanks on delivery trucks now. So companies replace their older, perfectly usable tanks with new ones to meet the new regs.
Huh. Regulatory churn driving demand.
Yeah. And in residential propane, you often see the propane retailers swap out a tank when a customer switches providers. Even if the old tank is fine, it's partly branding, partly liability. And those old tanks, they usually just get scrapped, not often refurbished and resold.
So constant turnover, even if the total market isn't growing much. What about cast iron boilers? That sounds very replacement heavy.
Oh, absolutely. The cast iron boiler market is overwhelmingly replacement. Think about it. There are maybe 350,000 boiler orders a year in the U.S. Only about 5,000 of those are for brand new buildings.
Wow, only 5,000 new builds.
Yeah. So even if new home construction completely stopped using boilers tomorrow, it would barely dent the market, like 1% maybe. And ripping out an existing boiler system in a house, the pipes, the radiators, and putting in a heat pump, it's incredibly disruptive and expensive. That transition, if it happens broadly, will take decades. Many, many decades.
Yeah, I can imagine. Like trying to retrofit an old apartment building in New York City that has steam heat. It's just not practical most of the time.
Precisely. And there's another factor, especially for the bigger industrial tanks, what you could call a location mode. These things are heavy, right? And safety is paramount. Nobody wants leaks. So moving a massive old tank from one site to another far away, often just not worth the cost and hassle and risk. It's easier and safer to just buy a new one locally. That gives existing manufacturers a bit of a local advantage.
Okay, that makes sense. Given these are mature, sometimes declining industries, the big question for investors is often terminal value, especially with all the talk about moving away from fossil fuels. How do you think about that?
Yeah, it's a valid concern. For propane, though, there's a bit of a misconception. U.S. propane usage has actually been pretty much flat for 20 years. It mainly serves about 5% of suburban homes where extending natural gas lines just isn't economical.
Okay, niche but stable.
Right. Now, is there a long-term risk from electric heat pumps and things like that? Sure. And there are political debates, but propane is relatively clean compared to, say, heating oil. And importantly, Canada, which is a bigger market for TerraVest, generally has a more supportive political environment for oil and gas right now. Plus, there could be some upside if Western Canada's energy markets sort of normalize.
And the boilers, is that really a sunset industry? Should we worry about it disappearing?
Look, it is a sunset industry, but someone described it perfectly as a beautiful sunset.
A beautiful sunset.
Yeah. The insight here is that huge value can be created not just by chasing growth, but by being really disciplined with capital in mature, cash-generating industries where maybe competition isn't fierce because nobody new wants to enter. TerraVest is masterful at this. They extract steady profits from a market others might ignore as dying, and then they redeploy that cash into areas with better returns, like acquisitions. They know it's a sunset, and they manage it that way.
So management isn't kidding themselves about growth. They're optimizing for cash flow and smart reallocation. That's actually quite reassuring. What about cyclicality, though? Oil and gas has been good lately, but we know that can turn. How much does that swing their results?
Well, there is some cyclicality, but probably less than you might think at first glance. That's because so much of the business is replacement-driven. If your boiler breaks in winter, you replace it. If your industrial tank starts leaking, you replace it. It's not really optional spending.
Needs money.
Right. And specifically on their oil and gas related business, it actually tends to lag the broader market cycles. For example, the big oil price crash in 2014. It didn't really hit TerraVest results until 2015, maybe 2016.
Yeah.
And the recent energy rebound, they only really started seeing the benefit in their numbers in the last quarter or so. And here's a critical point. Downturns can actually be good for their strategy
Also,
because that's when acquisition opportunities get better. Sellers become more distressed, valuations potentially come down. It acts as a kind of natural hedge for their roll-up model. They can buy low when times are tough.
that's clever. A counter-cyclical acquisition advantage allows them to keep deploying capital even in a downturn. Okay, so beyond the operational smarts, let's talk about what many people say is the real core of the story here, the management team. How aligned are they?
Oh, exceptionally aligned. It's quite remarkable, actually. The top 5 senior managers have the vast majority of their personal net worth tied up in TerraVest stock. And their base salaries are pretty modest. The CEO, for instance, I think his base was around CAD 400,000 last year.
Okay, not peanuts, but low for a CEO running a billion-dollar company.
Exactly. But look at their long-term options. They go way out to 2032. If the stock just compounds at, say, 15% a year, which is below their historical average, by the way, the potential payouts are huge. We're talking like the executive chairman's stake could be worth over $500 million Canadian dollars. The CEO's maybe 80 million. The CIO 55 million. These are pre-tax numbers, but still.
Wow. Those are absolutely staggering potential numbers. That certainly aligns interest.
It absolutely does. Even if you dial back that 15% assumption to something more conservative, maybe 8%, the potential rewards are still life-changing and represent a massive portion of their wealth. For the CEO, his TerraVest stock is probably well over 75% of his entire net worth. So they are truly incentivized to think and act like long-term owners, not just managers collecting a salary. It's exactly what you want to see.
Yeah, that's powerful alignment. Makes you feel like they're in the same boat as shareholders. Okay, let's shift to valuation then. The stock trades around 14 times current free cash flow. That's after adjusting for recent deals and the fact their actual capital spending is usually lower than their depreciation charge. Now, for a core business growing at maybe 2% organically, is 14 times free cash flow cheap? No, probably not cheap in the traditional sense for just the core low-growth business. You're right. The whole investment thesis really hinges on their continued ability to find and execute these accretive acquisitions. That's the engine. Historically, they've grown earnings closer to 25% per year through this strategy, and frankly, the multiple didn't really expand much until fairly recently. The challenge, of course, looking forward is taking a billion-dollar company and growing it to, say, $5 billion, primarily through acquisitions. That gets harder. Yeah, that's the big question, right? Can they keep finding enough deals, and maybe bigger deals, without overpaying or messing up the integration?
It's definitely the key risk and the key driver for the thesis going forward. It requires continued execution. However, there are just so many small, fragmented, adjacent industries out there. We talked about water storage with Highland tanks. Think about all the niches you see if you go to industrial trade shows or read trade magazines. Tiny, privately held companies everywhere. And this management team, they have this entrepreneurial knack. They tend to surprise you by finding opportunities you didn't expect. So while it's a challenge, the runway still seems pretty long. That's why I'm personally comfortable with evaluation, even at 14 times.
That entrepreneurial skill in finding those niche deals is crucial then. Okay, what about capital allocation generally? They pay a small dividend, you mentioned, around 10% of free cash flow, but they're not really buying back stock right now. Why the dividend if the focus is acquisitions?
Yeah, the dividend is interesting. My understanding is it's largely due to a specific board member, the founder and former CEO, who prefers some income. Management doesn't really talk about it as a core strategic use of cash. It's just kind of there.
Okay, legacy reasons.
Pretty much. As for buybacks, they're definitely open to it when it makes sense. They haven't done it recently simply because they feel the returns on acquisitions are much better right now. But back in 2018, when the stock was cheaper, they did a big tender offer and bought back about a third of the company's shares, so they will pull that lever aggressively if the price is right.
Right, so opportunistic on buybacks, but acquisitions are the priority now. That sounds like disciplined allocation. Okay, this has been incredibly insightful, a really deep look at how they operate. As we start to wrap up, what do you see as the main risks here? What could genuinely throw this story off track?
I think the number one risk, honestly, is key person risk, specifically the CEO, Dustin Hall. So much of the story revolves around exceptional management, capital allocation skill. His leadership is absolutely central. Now, there's a good team around him, no doubt. but his departure would be a major blow.
It's a management quality story, fundamentally.
It really is. Second, maybe some growing pains. The core head office team is still pretty small. As they get bigger and manage more diverse businesses, they might need to build out more infrastructure, more processes. Can they scale the management structure effectively?
Makes sense.
And, while we talked about cyclicality being mitigated, it's still there. A really deep, prolonged industrial downturn could still hurt results, obviously. And related to that, the lack of proactive investor relations, no calls, low stock liquidity that could become a negative in a bad market. If results dip, you could get an information vacuum, maybe panic selling, driving the stock down further than fundamentals warrant because management isn't out there calming nerves.
So the low profile could cut both ways.
Exactly. Though for a true long-term investor, a temporary dislocation like that could actually be a fantastic buying opportunity. But overall, you have to have comfort in management's intense focus on costs and their proven ability to navigate downturns. Remember, they managed through the 2014 oil crash just fine. They aren't overly indebted. They're usually the ones buying when things get tough.
That's a crucial point. So summing up this deep dive into TerraVest really highlights the power of, well, exceptional management and super disciplined capital allocation. They find and unlock value in these overlooked, maybe unglamorous industrial segments.
Yeah, it should really leave you with a fresh appreciation for where truly enduring value can be found. It's not always in the flashy headlines or the latest tech thing. Often it's in these foundational, critical, maybe boring parts of the economy that just keep on ticking.
So thinking about this, what does it mean for you, the listener? If a company focused on propane tanks and old-school boilers can compound shareholder wealth at 30% a year, well, what other hidden opportunities might be right under our noses? Opportunities just waiting for the right kind of attention, the right operational brilliance.
It's definitely something to think about. We encourage you to reflect on this really fascinating case study and maybe just look around and consider where you might find similar overlooked pockets of value in the world.
Thanks for diving deep with us.